Much like the rest of the world, pricing trends in Canada have increased rather dramatically over the past couple of years. And this upward move took a number of clients by surprise after well over a decade of soft market conditions. From a financial perspective, the increases were significant. It's not uncommon for the price of coverage to be in excess of 20% more than what insureds would have accounted for in their budgets when they bid for a tender and signed a contract. And that's a significant difference in terms of pricing, which is eating into what are already very thin profit margins for companies working in the construction industry. We have to keep in mind that this industry is heavily reliant on finalizing the pricing model for a project well before construction is due to begin. These projects tend to require extensions, and in the current climate, with sites being shut down due to COVID-19, these could be multiple. So by the time you get to the end of a project, insurance pricing could be a lot higher than what was accounted for in the beginning. And many times, the extra costs are coming either out of contingency funds or out of the insured's pocket because they are not able to pass it on to the project owner. The COVID-19 pandemic has complicated matters. Aside from stop work orders that delayed projects and created the need for further coverage extensions, clients were also facing supply chain issues. When the cost of raw materials increased, they pushed up the overall cost of the project, which also increases the cost of insurance. The biggest challenge has been the level of uncertainty. To bid effectively for a project, you have to be relatively certain in your budgeting. But we're talking about projects that won't be started for several months or even years. Often, the market is different when the project is about to start and coverage is sought than it was when the contract was negotiated, and the contract terms would be reflective of a market that is no longer the current reality. In some cases, terms that were included in a contract 2, 3, or 4 years ago are no longer commercially available. There are specific areas of concern where insurers are taking very hard stances and certain projects are becoming more difficult to secure coverage. For example, residential works and hot tar roofing. We're unlikely to see improvements in market conditions in the near future, so insureds need to be prepared to continue facing these challenges. Many insureds had become accustomed to a soft market, where they were able to approach their insurer late, provide limited risk information, and still obtain the coverage that they needed at a reasonable price. But that's no longer the case. Now, insureds need to provide best-in-class data that provides details on how risk will be managed, including identifying major contractors that will be working on a project and presenting risk mitigation plans for different perils, such as water damage. Secondly, insureds need to be willing to look at alternative markets to obtain coverage, as well as different ways to structure their risk transfer portfolio. For example, consolidating programs to try and secure premium credits from an insurer or revising retention levels. They also need to be ready to market their project, but all this requires time. A comprehensive process may take months to deliver results, so start the process early, gather good quality data, and be prepared to explore alternative solutions.